Hello and welcome to another video in our Dolfin Discussion series. I'm Geoff Wan, responsible for fixed income and credit strategies in Dolfin's investment management team. And today we're delighted to be joined by our guests, Bennett and Richard Briggs, to discuss investment opportunities in emerging market debt. Our clients will know we've been speaking at length on how we can enhance the yields in our portfolios in this low rate environment through maturity extension, dipping down the credit spectrum, or hunting for emerging market premium. Now we're joined by Bennett, who's in Singapore with us today. He's portfolio manager and head of Diamond Capital Singapore, where he manages its Asian high yield strategies, including distressed and special situations funds. And Richard joins us from GAM Investment, where he's an investment manager for multiple EM strategies, including hard currency EM debt and sovereign EM credit. Just for full disclosure, Richard and I used to work together. We cut our teeth in credit working together, so we share a very common vernacular when it comes to discussing fixed income markets. Now, thank you to both of you for joining us here today. Why don't we just get right into it? I wanted to use the format that Dolfin's investment management team used to invest in the fixed income markets, and that's through MVST, or macroeconomics, valuations, sentiment, and technicals. Now, looking at this back at the previous quarter, the recovery in credit markets in the US and Europe has been in large part driven by the central bank response. We've seen the Fed this week launch its primary market corporate credit facility, and we've also seen the ECB bid in the markets through its pandemic emergency purchase program. Can you talk us through what actions central banks have been making in the developing countries? And Bennett, why don't you kick us off?
Okay, sure. So I'll start talking about China, since it's the biggest economy within the Asian region. So different countries have taken different policies, and most of them have done both monetary and fiscal stimulus. With regards to China, even prior to COVID-19, in January, the PBOC, they implemented a broad-based reserve requirement ratio cut, also called a triple R cut, by 50 basis points, which released about RMB 800 billion of liquidity into the system. And during COVID, in March, the PBOC did a more targeted triple R cut of about 100 basis points, which released about 500 billion of liquidity. And this is mainly targeted at banks that focus on lending to small and medium-sized enterprises, also called SMEs. And the PBOC followed that up with another triple R cut in April by 100 basis points for small and medium-sized banks, again releasing another 400 billion of liquidity, mainly targeted at increasing lending to SMEs and to the real economy. With regards to fiscal policy in China, the government has implemented a fiscal stimulus of about 5.2% of GDP in 2020, and that is expected to contribute about 3.2 percentage points to GDP growth in 2020. So some of the aspects of the fiscal stimulus included VAT tax cuts, lowering electricity and gas prices, allowing deferment of corporate income tax payments, government subsidies to social security funds, and increased government expenditure, primarily on coronavirus relief and infrastructure investment. For Indonesia, the government on the monetary side, they have also cut rates by 75 basis points, which was implemented by the Bank of Indonesia. And on the fiscal side, the government implemented fiscal support measures under its economic recovery program that will total about 4.2% of GDP. So that includes, tax relief for businesses, for individuals, cash transfer program for low-income households, electricity subsidies, subsidies for household loan interest rates and down payments. And there are also some sector-specific stimulus, such as to support the tourism sector, where stimulus was allocated for airlines and travel agents in the form of incentives and discounts. There were reductions in airport charges, aircraft fuel price discount, and on the trade side, there was exemption of import income taxes for certain selected industries.
So there's a wealth of supportive measures there,
right? Yeah.
In China to support small businesses. And Richard, what are you hearing in other regions?
So, I think for emerging market sovereign credit broadly, the moves by the Fed and also even the ECB are probably the most important here in reality, rather than what's happening at the individual level. That's probably more important for local credit markets. But the Fed's bond buying and liquidity provision, has really been supportive for developed market credit, and ultimately emerging market credit trades off of that, and it's been supported. Very specifically, in terms of the central banks we look at, particularly in places like CEMEA and LATAM, for instance, they've all been cutting interest rates fairly aggressively in most cases. The big news, though, has been purchases of government bonds by lots of these central banks. So, in what's been described by some analysts, as EMQE, basically. Now, I don't view that as hugely problematic for credit. That's largely because you have fairly significant sort of deflationary pressures which already exist at the moment, given the real hit to demand within emerging markets. It's basically whether those central banks, how they manage the optics of those purchases. Does it raise concerns that you're going back to the sort of 70s and 80s, where this was sort of more routine, where central banks basically bought government bonds and funded government spending, and it culminated in inflation. But I don't think we're in that situation at all. The magnitude of most of it is actually reasonably small at the moment. For the high yielders, though, that's less of a focus. Lots of the frontiers, don't have the capacity to be able to do that. They have, big external funding needs, for example, and their policy room is substantially narrower in the likes of CE and Asia, for example.
Sure. And on top of the fiscal stimulus and the financial assistance that's being directly applied to support individuals and businesses, are there other forms of support for EM bond issuers, say from the IMF or through other debt relief programs?
Yeah, so fiscal support's obviously been key because you've had to cushion that very aggressive fall when it's meant a huge opening up in deficits, and you've seen sort of deficits in the teens in places like South Africa, India, Brazil this year. But outside of that, the IMF has been providing support via its rapid financing instrument and also its rapid credit facility, which basically provide emergency assistance very quickly. They doubled the access to those facilities very early on in the crisis, and they've given a large number of countries at this point. Lots of countries who were already with speaking to the IMF have also been going into new EFFs, which are extended fund facilities, basically longer term programs. Alongside that support that the IMF is providing to bridge balance payments needs, there's also the G20 working with the IMF and the World Bank. Basically agreed that they could potentially suspend repayment of official bilateral credits for the poorest countries. Now, the IIF, alongside them, is trying to encourage private sector creditors to do so. It would be on an NPV neutral basis. So basically just suspending payments and pushing them sort of further out. But so far there has actually been mixed uptake for this debt relief. Most issuers haven't, on the private sector side, particularly looked at, attempting to do that. Lots of them are concerned about, how it would be perceived by the agencies, and then also what it would mean for potentially future market access. But those are the kind of supports which have been coming through.
Sure. So we've seen comparable accommodative measures, both monetary and fiscal, in the emerging markets then. Just turning to the nature of the crisis. Now, we're starting to see COVID infections in developing countries, including Brazil, Mexico, Peru, India. they're now in many instances overtaking the infections and deaths that we're seeing in developed countries. And as recently as last week, we saw a second wave hit Beijing. We saw a swift return to lockdown measures. How should investors view this and position in line with this?
I think that kind of varies depending on which country we are talking about. Specifically in Asia, China has done a very good job with regards to containing the COVID virus. When we had, what some people call a second wave in Beijing, that was shut down pretty quickly. As of yesterday, there was only one new case in Beijing. And if we talk about on a weekly basis, in the recent week, the average daily infection fell to 17 from 31 a week ago. So the numbers are not that high. Having said that, China moved very fast with regards to containing the outbreak. For example, 42 sub-districts in Beijing, they raised their COVID-19 risk levels to medium or high. So the country is very well prepared, for a recurrence of the outbreak. Whereas, for some other countries such as Indonesia, India, and Philippines, where the household income per capita is not as high, and more people, are in the low income category, and they have a lot larger of a blue collar population. They needed to balance, how drastic of a lockdown they should implement, and the economic impacts of it. As such, countries like Indonesia, India, and Philippines, they had to relax the lockdowns earlier than they should have. And as a result, the infection rates have continued to remain high. So there is a bifurcation in terms of how countries are responding to COVID, and the results that we have seen. Like for countries such as Korea, Singapore, and Hong Kong, the outbreak has pretty much been quite well contained.
And with that, which companies, and in your case, Richard, which sovereigns do you expect to be most resilient given the current economic conditions? And are there particular areas of stress that you want to seek to avoid as well?
Yeah, so I mean, COVID's obviously been hugely important in terms of how we are doing analysis at the moment. I mean, we have a daily call where we discuss the latest numbers every single day, and it's something we're constantly following. On a country by country level, though, it's not been so much just about where you've seen a big rise in cases. You've seen countries like Brazil with a huge rise in cases. I mean, it hasn't necessarily translated into Brazilian spreads being the weakest within sovereign credit, for example. Where I think it matters is, how does it feed through to demand? And then in turn, how does it feed through things like commodity prices, for example? So it's, being careful to look at, particularly in the oil exporters, who can handle if oil basically remains around, sort of $30, $40 a barrel, potentially over the rest of the year into future years even. It's also about, avoiding those which have very, very high tourism exposure, for instance. We don't have any exposure to things like the countries in Central America. Lots of them very, very reliant on tourism, for example. And then also remittances in some cases, we're watching very carefully to see, how much pressure they're under. They were under lots of pressure very short term, but they have rebounded, in places like in Egypt, places like El Salvador, Pakistan, they have rebounded a bit. And then lastly, it's also about being careful to not take too much exposure to those who have very large sort of external refinancing needs. Conditions to refinance have become much more difficult for the very high yielding emerging market credits. We have seen some more issuance recently, but for lots of the weakest issuers, it would be very difficult for them to do that via private sector sources. Where countries that's not the case, though, I mean, places like Egypt have, huge buffers, and they have seen pressure, but they have very high foreign exchange reserves to basically compensate for that. Some of sub-Saharan Africa as well, we're looking at, spreads are still very wide, and it's very case by case. But some of those are less reliant on private sector external financing than others. They're more reliant on, say, multilateral financing or bilateral financing, or potentially, in the likes of Kenya, for example, the goods exports that they sell tends to be much more diversified. So it's not entirely focused on something like oil, for example. In the GCC, just very quickly, I mean, places, in terms of looking at where it can cope with oil, the likes of Saudi Arabia, Qatar, we think, offer good valuations and can cope for an extended period. But places like Bahrain and Oman really can't. If oil prices stay where they are over the next couple of years, they could be under real pressure, and it'll be a question of whether they get support or not. So that's how we were sort of looking at it.
Okay, so just turn to geopolitics then. The relationship between the two superpowers, US and China, it's been very volatile this quarter. I mean, on a positive note, Michael Pompeo's claimed that Chinese officials have recommitted to their obligation towards phase 1 of the trade deal. But on the flip side, China's just passed the National Security Bill in Hong Kong, and the US Senate bill was also passed to restrict Chinese firms' access to US capital markets. Bennett, why don't you just give us an update on what your view is on the US and China trade war and the potential for risks to re-escalate again?
Well, I think that is politics is something that is that could be potentially hard to predict. But I think on the balance, it's quite clear that neither the US or the China would really benefit from a long, drawn-out trade war. So I think to the extent that each country can, they would try to keep it, as controlled as possible.
Yeah, that makes sense. Okay, so thinking about valuations, we've actually seen incredibly strong double-digit returns this quarter across EM high yield in Asia, Latin America, and EMEA individually, and all outperforming the US and Europe. So is this still the right time to invest in emerging market debt? And where do you see the most attractive valuations and investment opportunities?
I mean, I think it is. I think it's extremely key at this point. I mean, where I look at in terms of EM sovereign credit, that you have active management. Of course, I'm going to say that, but I think it is extremely important at this point where, we are, getting a decent amount of yield from the asset class on a relative basis, but there has been fundamental deterioration over the last sort of 20 years or so, particularly in the lowest rated parts of emerging market sovereign credit. Now that means that, actually some of the rewards potentially are the highest they've been in a long time, but it also means there's the potential for sort of a big increase in defaults and pressure in lots of those issuers. You've seen more sovereign issuers, credit issuers, which are in distress at the moment than, there has been, for probably 2 decades, basically, when you just got the sort of period around the financial crisis where most sovereigns were actually okay. I think actually valuations versus DM high yield, EM still reasonably elevated. We obviously saw a lot of compression over the second quarter, but it has to be very selective in high yield, as I mentioned previously. You have to be really looking at fundamentals very carefully in sovereign credit. In IG, there's some spread pickup to be had, but we're back to sort of more normal levels on a sort of EM versus DM high IG basis at this point.
And Bennett, do you have any preference for region, quality, as a part of the maturity curve that you prefer, given where we are in this point of the credit cycle?
Well, I think, we would generally prefer high quality credits with a bias to a shorter duration if the extra yield pickup is not attractive for duration extension. In general, we assume a global recession as our base case scenario, macro outlook for 2020. As such, we will have a bias towards companies with resilient, sustainable business models, strong balance sheets, robust cash flow generation ability that will enable them to survive a global downturn. So we'll focus on maintaining a good margin of safety in our investments, even if macro developments turn out to be worse than our expectations, the credits that we invest in will still have a high probability of surviving the downturn.
Sure. Just turning to the capital markets then, it's been very accommodating for issuers. We've seen very strong investor sentiment, and primary markets have been on fire. Emerging market hard currency new issuance is hot and it's running at a record pace this year. How are you viewing this abundance of new supply? Should we look at it positively or negatively?
So yeah, I mean, I think, IG has been very, very high, and IG's been running at record levels. High yield, actually, in EM sovereigns particularly, has actually been sort of more recent over the last month or so. I think in some ways it's positive. I mean, it means that, there is access to financing for sort of more solid issuers, the likes of Egypt, for example. You are seeing lots of smaller issuers like Belarus, Honduras now coming to market, though Jordan also came to market this week. I think actually, lots of them are still having to pay to come up, pay to come to market with decent new issue concessions. So, we look at them very much on a case-by-case basis. But I think it signifies that, if you're a strong issuer, you do have access to funding. And I think actually, looking at some of the deals this week, actually when the issuers announced they were issuing, spreads actually tightened rather than widened. So there wasn't a huge concern about supply risk there. I mean, Ukraine, for example, is one example there, which did tighten yesterday. It has widened out this morning because of the resignation of the central bank governor, and they've actually cancelled the tender offer and the new issue. But generally, things, I think it would be comforting.
Sure. Are we hearing something similar over in Asia, Bennett?
Well, supply has picked up after a pause in March. New issuance volume has caught up with last year's numbers if you look at IG and high yield combined. But if you solely look at high yield, high yield has been tracking below 2019's pace. Overall, technicals remain supportive because global monetary easing has unleashed fresh liquidity into the global financial system. We see global investors adding to risk in China, India, and Indonesia corporates in recent months. In addition, Asian fund flows have also turned positive again, and we've seen private bank clients, stepping up and getting back into the market. So overall, the environment has rebounded quite a bit from March, April.
Mm-hmm. And what we've also observed is that recovery rates are seemingly lower in this particular credit cycle. And that's partly driven by the lower return on assets. And we've seen a higher mix of secured issuance, that's first lien paper, and they're coming out pretty attractive yields. So we've had a preference for this given where we are in the particular cycle. And that's how we've been playing in the Dolphin's investment management team. Now, we've touched on a lot already. I just want to ask, what are your expectations for EM debt as we move into the second half of the year? Are there any key elections that you're watching out for? Any other pertinent risks that you think are worth mentioning for our viewers?
Yeah, I mean, obviously for the second half now, visibility isn't great. I mean, the virus is still clearly out there, and we're looking at how a second wave could evolve and how it's also managed. Obviously, the US elections as well are a huge issue, I think. At name level, though, that's things like Russia could be under more pressure. They have I'd say widened a bit over the last 2 days, just in the back of concerns about what a new US administration might do. But I think, it's sort of more top level, how that affects overall sentiment rather than big pressure at country level for most of these issuers. Then obviously you've got the trade war, but again, Where that affects most is places like Asia, but in credit, for example, these are some of the strongest credits. So I think it's more about the sort of macro kind of sentiment rather than a country by country allocation decision for that. I think though, ultimately at least these kind of levels where spreads are still, compressed considerably where they were, a couple of months ago, but they're still much wider than they were, say, at the start of the year at this point. So closer to where they were, around about last year. So I think at these kind of levels, spreads in sovereign credit at least should, tighten marginally or at the very least tread water. So I think for us, that means, positioning to be sort of marginally overweight beta, but doing, so very, very selectively, as I mentioned, down in the sort of single B high yield and single B and also distressed here, very, very case by case that we're looking at it.
Sure. And Bennett, as we head into earnings season, and what are your thoughts on the remaining half of the year?
Well, I think in general, we are going to see lower profit margins for most companies because the slowdown is affecting most countries and most sectors. Having said that, overall, we feel that valuations for Asia credit, they look relatively attractive compared to other regions, especially when the key Asian economies such as China, Hong Kong, Singapore, and Korea are well ahead on the inflection curve. And in terms of valuations, Asian BB credits, they offer a 1.3% more yield pickup with a 1.6 year shorter duration compared to US BB credits. And then if you look at Asian single B credits, Asian single B credits, they offer 3% more yield pickup with a 1.4 year shorter duration compared to US single B credits. And this is not because, the credit quality is weaker. If you look at, the credit metrics, of Asian corporates, in general, they have, they appear to be relatively much stronger than US credit. For example, the Asian high yield index, the net leverage is about 3.7 times. And when you compare that to US high yield, it's 1 time lower with US high yield's net leverage at about 4.7 times. And if you look at, the default rate over the past 15 years, the average default rate for Asia credit is about 1.76%, and that is lower than the 2.35% for US high yield. So, on a whole, we think, investors are getting adequately compensated for the risk that is being taken on. In terms of, return expectations, I think, on a base case, we can expect to get carry on the core portion of the Asia credit portfolio, while select credits that have sold off more could potentially provide some capital appreciation upside.
Look, it's been great speaking to both of you on emerging market debt opportunities. Bennett and Richard, thanks for taking time out of your busy schedule and having this conversation with us today. It's been an incredibly interesting topic to discuss. And for our viewers, we have additional upcoming Dolfin videos. We will be discussing the road ahead for electric vehicles and also discussing unemployment as well. Now, thank you again for watching.